Welcome to this explainer. Today, I want you to imagine we're just sitting right across the desk from one another. I'll be stepping into the role of your financial planner to walk you through a comprehensive wealth management consultation. Because building and preserving wealth over decades, well, it's not just about picking hot stocks. No, it's a structured, highly disciplined process of managing long-term risk.
So let's dive right in with the most fundamental question. Beyond just having enough money, what is it you actually want your wealth to achieve? Clients usually come in with pretty general ideas, like, I want to fund my kids' college, or I want a comfortable retirement. But as your advisor, my job is to push you past those generalities. We need to take those vague desires and turn them into concrete, highly measurable targets.
Here's our roadmap for today's consultation. We're going to cover defining your wealth goals, navigating long-term economic risks, overcoming your behavioral biases, the power of asset allocation, and finally, staying the course.
Okay, Section 1, defining your wealth goals. Moving beyond the basics to quantify your future. This is exactly where we start the whole wealth management process, by identifying your specific, highly individualized objectives.
First up, we've got to look for what we call hidden goals. Basically, these are your safety margins, your rainy day reserves for those unexpected life curveballs. Dipping into that safety margin can seriously lower your standard of living, so we want to quantify it up front and lock it safely away in low-risk instruments. Next, we plan for medium-term goals, like education, by nailing down exact amounts and timelines. But here's where it gets really fascinating. Estimating your retirement horizon isn't just about glancing at standard actuarial tables. We literally have to look at your family's unique genetics and history. To figure out how long your money needs to last, we actually have to look at the life expectancy of your closest relatives. Crazy, right?
Moving on to Section 2, navigating long-term economic risks, external threats to your portfolio's purchasing power. Once we've got your timeline mapped out, we absolutely must pivot to the external forces threatening that horizon. And we start with the ultimate silent wealth killer, inflation. Keeping money in idle cash might feel incredibly safe, but over the long haul, it's actually really dangerous. Let's look at the math here. Say you've got an investment earning a 7% nominal return every year. Sounds fantastic, right? But wait, if inflation is running at 3%, your real return, which is the actual increase in your purchasing power, is really only 4%. Our big goal here is to generate returns that consistently outpace inflation so your wealth actually grows in real terms.
To pull that off, we need absolute resilience. Think of a tree surviving right on the edge of a harsh cliff. That's the perfect metaphor for what we call patient capital. Right now, massive global family offices are repositioning their portfolios exactly like this to endure structural, K-shaped economic uncertainty, where some sectors completely thrive while others plummet alongside serious geopolitical fragmentation. They aren't just reacting to the latest cyclical stress. No, they're preparing for a world where heightened risk and massive government borrowing are just lasting, permanent features. They're widening their geographic diversification and bracing for a huge range of long-term outcomes.
Now, in times of high uncertainty, people naturally look for ways to protect their wealth, especially from taxes. You've probably heard of strategies like buy, borrow, die. It's a concept where wealthy individuals hold on to their wealth by buying appreciating assets, borrowing against those exact assets for cash to live on, and then just holding them until death to minimize capital gains taxes. It sounds like a magic bullet, doesn't it? But as your advisor, I have to warn you about the severe risks of this kind of over-leveraging.
Let's break down the hidden dangers of that strategy. If you borrow heavily against your investments and the market takes a sudden dip, well, the underlying assets lose value. That means your lender is going to immediately demand additional collateral. And if you're holding massive personal debt while interest rates are rising, boom, you can trigger instant margin calls. Just like that, this debt-heavy cascade can completely wreck your long-term financial health. It's literally a house of cards.
And it doesn't stop there. We aren't just planning around inflation and debt anymore. We also have to price in the massive economic wedge that the expected arrival of transformative AI could drive right into capital returns over the next 30 years. Right now, economic models are scrambling to factor in the probability of AI arriving at different dates over the coming decades, because it fundamentally alters long-term interest rates and capital returns. So as your advisor, I have to ensure your portfolio is robust enough for a future that is structurally uncertain.
Which brings us to Section 3. Overcoming your behavioral biases, the enemy within your own mind. We've talked a lot about external threats, but behavioral finance proves time and time again that your own psychological traps are very often your absolute biggest liability.
Believe it or not, the wealthy are incredibly prone to these cognitive biases. Take conservatism. It makes you fear losses even when the market news is actually good. Or how about anchoring? That's when you fixate entirely on a stock's latest price level, treating it like some privileged boundary for future performance. Then there's representativeness, which leads you to judge the future purely by what happened in the recent past. Thinking if it went up yesterday, it's definitely going up tomorrow. And finally, overconfidence. This leads investors to blindly trust second-hand advice or dump money into local companies just because they're geographically familiar, falsely equating that familiarity with safety. Big mistake.
So a really crucial point here is avoiding something called hindsight bias. That's the completely false belief after an event has already occurred that you accurately predicted it all along. We see this all the time after major market crashes. Clients, and honestly, even some highly paid advisors, convince themselves they saw the whole breakdown coming. And what does that do? It leads to completely unjustified overconfidence going forward.
To combat these natural deviations from rationality, we need serious structural controls. You must demand that I, as your advisor, use future-looking guidelines rather than just pointing at past results. We need to regularly review how your exact portfolio actually performed during past crises to ground our expectations in reality. You also want to ensure my compensation isn't just some bonus for selling you financial products. And perhaps most importantly, we need a solid long-term plan with strict, predefined rules for when we enter and exit the market, completely ignoring the daily economic noise.
All right, Section 4, the power of asset allocation, your blueprint for resilience in any weather. Academic research overwhelmingly shows that asset allocation is, without a doubt, the single most important factor in determining your portfolio's returns. In fact, it's often called the only free lunch in investing. Why? Because putting together a strategic mix of different assets vastly outperforms the chaotic, stressful attempt to actively time the market. What we're doing is carefully balancing your specific risk tolerance against your unique time frame.
The basic premise here is that different assets perform very differently in varying economic conditions. By mixing traditional assets like equities for growth and fixed income or bonds for stability with alternative assets like real estate or commodities, we create a truly diversified portfolio. The returns of these different investments aren't perfectly correlated, so when one zigs, the other zags. This significantly reduces your overall risk while still maintaining your expected return.
A highly popular method we might use for you is what we call the core satellite approach. Essentially, this means we lock the vast majority of your wealth into a long-term, stable, strategic core portfolio that we rarely ever touch. Then, we leave a much smaller satellite portion of the portfolio flexible. This allows us to dynamically trade and take advantage of short-term, tactical market opportunities without ever risking your foundation.
And finally, Section 5, staying the course, discipline, time, and the mathematics of compounding. Why? Because a beautifully designed, well-allocated portfolio means absolutely nothing if you abandon it during a period of temporary market anxiety.
In wealth management, time is arguably your most critical variable. As a rule, one outlined by experts like Harold Davensky, we absolutely must commit to our strategic investments for a minimum of 5 years. This 5 years rule ensures that the allocation actually has the time it needs to work its way through full market cycles. If you pull out at year 2 just because you're feeling nervous, you literally sabotage the entire mathematical foundation of the strategy.
To show you exactly why time matters so much, let's look at the sheer, mind-boggling power of compounding. Say you make a simple $1,000 investment, and it grows at an 11% rate of return. After 3 years, you have about $1,367. Not bad. But if you leave that exact same $1,000 invested and completely untouched for 30 years, it turns into nearly $23,000. That right there is exactly why discipline pays off.
As this explainer highlights today, and as the latest industry reports constantly confirm, my job is not to predict tomorrow's market dip. My true role as your advisor is to provide the context, the insight, and the structural discipline that keeps you perfectly aligned with your life's goals. When the market gets volatile, and it will, I'm here to provide the proactive communication that helps you weather the storm without making emotional, costly mistakes. So I want to leave you with this final thought for our consultation today. Now that you know the external risks, recognize your own internal biases, and truly understand the sheer mathematical power of a disciplined asset allocation, are you ready to stop worrying about the daily noise and finally commit to a structured, resilient financial horizon?